In the calendar year 2021, Indian companies had raised around 9 lakh crores through equity and debt. Of this, around 5.53 lakh crore was raised through debt market and 2.1 lakh crore was raised through equity. There were other amounts like 30,840 that was raised through REITs and InvITs and 1.06 lakh crore through overseas route, which includes your ECBs or external commercial borrowings. Before this, in 2020 calendar year, the Indian companies had raised cumulatively approximately 11 lakh crores, and this year the amount is also on a higher side. But what exactly is debt and equity, and how is this money raised and how is it used, and which form is important or better for Indian companies to raise funds? In this video of Concept Padhayenge, Sabko Sikhayenge, we will talk about equity and debt. And in our subsequent videos, we will talk about the other forms like REITs and InvITs also. Hello everyone, welcome to iExamP. Don't forget to subscribe to the channel and press the bell icon. We started with our Concept Padhayenge, Sabko Sikhayenge series in November, where we focus on the most important concepts for you from various subjects, including finance, economics, general awareness, computer, agriculture, English, quantitative aptitude, and reasoning, which will be helpful for your exams. This month, we are focusing on various economic, banking, and financial concepts with focus on SEBI. As you are aware, the SEBI exam is expected very soon. The notification is expected in December and the exam is expected to be held in the last week of January. So this month, the concepts that we will be discussing, you can see the list of topics here, and today I am discussing debt and equity. So let's understand from a very simplistic point of view. Say you want to buy a car, right? And of course you can go ahead and buy the car from your own funds. However, in case you want more funds or help, you don't have the entire funds to buy the car, you may have two options. You may collaborate with your friend to buy the car together, or you may take a loan from your friend or family or somebody that you know to help fund your purchase of the car. In case you are collaborating and taking on one of the other persons to help you to buy the car, this is something similar to taking equity, where there is no promise to repay back or return the money that you have taken. So if you and your friend together decide that we will pool in the money together and buy the car, this you are giving an ownership to your friend also in the car, and there is no obligation for you to repay that money. You're also not promising any kind of return or profit or fixed regular income to your friend. However, any kind of profit that you may have, say by renting your car or later on selling it and making a profit on the sale, any share in that profit you will have to share with your friend. If you make any losses, say for example the car is damaged and you are not able to recover that money through insurance, then if there is any loss, your friend will also have to share the loss. So what you are giving to your friend in return to that money that he has invested with you in the car, you are giving him the ownership rights, right? So he is also the owner of the car, as are you. So this is also known as the ownership capital. And because you are not promising any return, or because the person or your friend is equally invested in the car in terms of the profits or the losses that may arise, this is also known as the risk capital for your friend. On the other hand, if you had taken funds as a loan from your friend or some third party, this is known as debt or borrowed capital. This money has to be repaid back as per the terms of the agreement. So this you may be either paying in small amounts as an EMI, that every month or every fixed duration you are paying back certain amount of the loan to the person who has given you the loan, or at the end of a maturity or a period in a lump sum manner. So the idea is you have to repay back this money at the end of a particular timeline. During the time you are using this money, you also have to pay a fixed return, which is in the form of the interest. So in case of debt, your upside is fixed because you have a promised interest rate which can be linked to an external benchmark or a particular amount that is being given as a percentage, and the downside is also limited because if there is any loss, it will be limited to the interest amount that has to be earned or paid on the debt. There are no ownership rights in that case. So if you have taken debt to finance the car remains yours, and the person or your friend who has given you the loan cannot have a claim over the car in terms of the ownership. This is also known as the borrowed capital for you. So if we talk, so this was the simplest example, but if we are talking from the point of businesses and corporates and the companies can actually raise funds also like this in two ways, either through equity or through debt. When they are raising it in the form of equity, the equity is brought in by the promoters or who are like the founders of the company, who start the company and bring in the initial capital or equity. Then the company can also raise money from private sources like through investors, and today there are various kind of investors. There are angel investors, venture capitalists, other AIFs, alternate investment funds that are there to provide capital and equity. Or the company can also approach the public at large through a process, the IPO. What is IPO? This has been explained in an earlier video of Concept Padhayenge Sabko Sikhayenge by Tushar sir. You will find it on our link to Concepts Padhayenge Sabko Sikhayenge page on iExamB website. When we talk about debt, the debt is not just limited to debt being raised in the market. It also includes the debt which the company may raise from banks and NBFCs and various other financial institutions in forms of loans. It also includes debt being raised from the markets or the debt markets from the public and various other investors. Thus, both equity and debt are capital. However, equity is your ownership capital, which gives you ownership rights, while debt is your borrowed capital, which has a limited return, which is predetermined and known in the form of interest. So the return in case of equity is known as the dividend. It is not promised and it is an appropriation of the profit, while the return on your debt is fixed and known and predetermined. It is known as interest and it is an expense for the organization and it is charged against the profit. That is, before arriving at the profit, this interest has to be paid compulsorily and is an expense for the organization or the company. So these are the basic features of debt and equity, and this is how we differentiate. Both of them are sources or important sources of funds. Now the question is, which one is better and the organization should go for which source, equity or debt? While, as we discussed, both equity and debt have their own advantages and disadvantages and features, and therefore a good mix of both of them is very, very important for the organization. The company first needs to have certain capital base, and based on that capital, the company can leverage that equity capital to actually grow its business, right? So if the company has enough equity and raises debt, it can actually help to increase the profitability capacity of the company by being able to expand its business and increase the level of activity, right? But what is important to keep in mind, that the business that the company is doing and generating the operational profit, this operational profit should be enough to be able to pay for the cost of the debt, which is the interest. So if you are leveraging your equity capital in such a manner that it helps you to cover the interest cost but increase your capacity in such a manner that it increases your overall profitability, then your debt can actually help you increase your returns. This is known as the leveraging of equity capital, leading to a good and optimal capital structure. That is what any company would aim at. It means a good combination of equity and debt in your organization overall. So this is a simple question for you. A debt holder is given which of the following? Is it fixed dividend, a fixed interest rate, voting rights, shares in the profit, or all of the above? This question actually came in the SEBI exam in 2020 in the phase 1. You can attempt this and such similar questions by visiting our page of Concept Padhayenge Sabko Sikhayenge. You can see the link over here. Various other videos which we have been doing you will find on this particular page. You can watch the video. You can also download the PDF of this and take a quiz. So you will find the answer to this particular question also in the quiz and many more questions. So don't forget to attempt this quiz, and don't forget to keep following us. Subscribe to the channel, press the bell icon, and prepare 50% faster with iExamB. Thanks everybody. Wishing you all the best for your preparation for various government exams.